All right, hey everyone, this is Kirk here again from Option Alpha, and in this video we're going to run through a SPY short call backtest where we actually test two different variations and multiple portfolio allocations for a naked short call option on SPY. Again, we're testing mainly the difference between a 15 delta and a 30 delta short call option strategy. And this one is really fascinating when we actually see the results of these two different strategies run back to back against each other. So I want to run through really quickly before we show you the end results of these particular strategies, what the setup was. I thought this was a really fascinating test because in this case, we know that over the last basically 10, 20 years, we've seen a really big move up generally, broadly in the markets. We've seen obviously some bear market moves and some crashes, but generally markets and equities have increased. So the idea here is, can we find a strategy where we go deliberately bearish on the markets, bearish to neutral with a short call option strategy where we're naked and we have undefined risk if the market continues to move up? Does that still create a possible winning strategy if you were to trade it over and over and over again? So the first thing that we tested was, of course, SPY against all time, trading weekly. So every week we're entering a new position. We tested three different capital allocations. So 5% of our capital per position, 7% and 10% of our capital per position. You probably have to scale up a little bit in this case because you have to cover the margin that's required to do a naked short call option. So ideally, we would have liked to test, something around 1, 2, 3, 4, 5, something like that. But those probably smaller allocations wouldn't have actually worked or probably would have, ran out of room to test in this case. And then again, we chose the short call option strategy. Our entry conditions for this one were testing the 30 delta. So the idea here is that we're selling something that's not at the money, that's a little bit out of the money, but not insanely far out of the money. So something around a 30 delta, might be a little bit far out of the money, give the market a little bit of room to move up, but trying to take in a higher credit in exchange for the fact that you have to sell an option contract a little bit closer to where the stock is trading. Again, not right at the money, but maybe, definitely a number of strikes out of the money from the SPY's current price. We did the days to expiration around 60 days, so it was about a 2-month contract every time that we entered a new position. We had no implied volatility filter. So this is interesting. We didn't say, okay, you only trade this when implied volatility is high or only when it's low. It was basically just trying to test the repetitive, consistent, mechanical selling of call options in SPY on a naked basis. And we didn't test any profit taking either. So we didn't take profits early. We just let it go all the way to expiration. And 2 days before expiration, we would close the position just to avoid assignment. Again, this is really helpful because once you start converting these over into bots at some point, you can again use these same logic functionalities to remove positions before expiration to try to avoid as much assignment risk as possible. So this was the result of this particular test. You can see actually that the strategy did pretty well and of course did well during the 2008, 2009, market collapse. Again, did pretty well throughout most of that period where it was making money. In fact, all the allocations were making money, but then it started to give up on the potential allocation. You can see at one point, the 5% capital position just didn't have enough money to enter new positions, so it kind of flatlined and basically died. It didn't have any room to enter positions. The other two positions lost money and just continued to lose money as the markets were rallying really, really strong heading into the early 2020 crash. So end result here is that the strategy did not do well at the end of the day, and it was hard to, again, make money in the face of a raging bull market in many cases. They had pretty decent win rates. You're selling options, again, right around a 30 delta. So you won a pretty decent amount of the time for pretty much all these positions, even just letting it go all the way to expiration. Again, this didn't have any profit taking in place. So it'll be interesting to test in other videos what the impact of profit taking might have been. But the end result, again, with this particular setup for a 30 delta was that it didn't make sense to do it. So you won early on. You just got lucky to, start trading right in front of a, major bear market move. That probably helped you out more than anything else. We did also test, though, however, a 15 delta short call option for SPY. And so here are the results actually of that short call option strategy, again, selling just a 15 delta. So in this case, what we did is we said pretty much exactly the same stuff. We did no IV rank conditions, 60 days to expiration. We sold a 15 delta, which means we actually sold an option contract a little bit further out of the money The original one that we just did was a 30 delta short call option. Again, no profit taking, no stop loss. We let everything go to expiration and close 2 days before expiration. This one ended up turning out well. In fact, you actually made money on this strategy. Again, the 5% allocation one started to flatline when it just couldn't allocate enough capital. So as the market was rallying in price and it became more and more expensive to cover that margin, it was just a little bit harder to allocate capital. But you can see that the strategy did, in fact, quite well. And although it gave up a lot of what it earned in the 2012, 13, 14 time period, just recently in the 2017, 18 period, it still ended up becoming a net profitable trade at the end of the day. So I think it's fascinating to see how these different strategies work out. You know, the way that I look at this, for sure, when I look at these different allocations, especially, you know, maybe the 7% allocation somewhere in between there, is that, you know, during this entire time period, you had not only just a decently profitable trade that you could probably add a small allocation to your portfolio with, but your risk that you took in this potential trade over the time period, knowing that we've gone through not one, but two, potentially three, however you look at it, major black swan events, you really didn't take that much risk. In fact, the maximum drawdown for all of these was pretty reasonable. So the 10% allocation, which was the highest allocation, probably a little bit too rich for me personally, but you only went through about 11% drawdown. The 7% allocation, you went through about a 6% drawdown. So it was a really, really good strategy to deploy if you just let it go to expiration. And again, we could definitely take this as a starting point and continue to optimize it, which we'll do in other videos and kind of show those. But the idea here is that if you moved out a little bit further, you could have conceivably traded the entire market very bearish. So your overall bias the entire time was completely one-sided, directionally bearish to neutral, and still would have had a decently profitable trade. Now, you wouldn't have caught up with, you know, overall market returns. You wouldn't have beat the market at this case, but it was an interesting test nevertheless. So hopefully this helps out. As always, if you guys have any questions, let us know. And until next time, happy trading.